You're a veteran and you're looking to buy a house in 2026. One of the big questions you're probably asking is, how much can we actually afford? The answer to that might actually surprise you. In this video, we're going to talk about how VA affordability is calculated, what things might be limiting your buying power, the importance of residual income, and then we're going to go through an example of some real numbers so that you get a good idea of how it's calculated. Here we go. When it comes to calculating your affordability for a VA loan, there's two main numbers, and one is your income. So your income, that side of the equation is basically base salary, BAS, BAH, retirement, disability, overtime bonus or commission income that you have a 2-year history of, and other types of income as well. But those are really the main ones. It's important to understand too that when it comes to calculating your income, it's about your gross income, not your net, but your gross. The other side of the equation is going to be your debts. And so when it comes to debts, we're talking about things like car loans, student loans, any kind of child support that you might have to pay, child expenses like daycare, things like that. And then the main one that most people forget is it's going to be the new housing expense, right? So that number we may not know yet because you may not have found a house. You don't know how much the taxes and the insurance are, and you don't know what the mortgage is going to be. So that's kind of the number that we're trying to back into. When it comes to your debts, it's important to understand that we're using the monthly payment. So it doesn't necessarily matter how much the balance is. Like on your credit cards, for instance, you might have $20,000 in credit card debt, but if your payment is $150 a month, that is the important number. And so once we have the income, and then once we have the debts, what we are then going to calculate is your debt to income ratio. The debt to income ratio is essentially your combined monthly debts with the new housing payment divided by your gross monthly income. And so again, since we don't know your gross monthly housing income, essentially what we're doing is backing into that number. If we know your gross monthly income and we know all of your other monthly debts, then from there we can figure out what your maximum monthly payment can be for a new property. So when it comes to debt to income ratio, conventional loans, you typically can't go above about 50% debt to income ratio. With VA, they're a little bit more lenient. They don't really give you a cap on that. And a lot of times they will approve you for more than 50%. Now, that doesn't necessarily mean that you should for that much. It just means that they may be willing to give you a loan for up to that price. You still have to determine whether or not the maximum that the VA is willing to lend you is in range of what your comfort level is in terms of how much you want to afford. You don't want to be house poor. Everybody has different lifestyles, so it's a personal decision as to how much you feel comfortable with as a monthly payment. So when we're looking at the debt ratio, the VA will also run a calculation which is called a residual income calculation. And that is actually a much more real world calculation of how much a family can afford. Because what they're looking at is they're looking at your income. So similar to the debt to income ratio, they're looking at your income, they're looking at your debts. And then what they're doing is they're saying, after you pay all of your debts, we want to make sure that you have enough money left over to pay for other things. The residual income requirement is based on two things. It's based on the family size. If it's you, your wife, and 2 kids, you have a family size of 4. And then it's based on the region that you're in. So there's 4 different regions, and there's a chart for this. And so family size and region will tell you what the minimum residual income requirement is for the VA. And that's the amount, again, that you have to have left over after you pay all of your expenses, after you pay the housing expense, to make sure that you have enough to live on. Really, what the VA is doing is they're looking at both debt to income ratio and they're looking at the residual income requirement. Now, typically, if you have a debt to income ratio that's under 41%, then at that point, as long as you meet the residual income requirement, then you should be golden. If we go above 41% for the debt to income ratio, then the VA is going to be a lot more strict on that residual income requirement. They might want you to exceed the residual income requirement by about 20% to make sure that you're going to be comfortable, because you are approaching the upper range of your max affordability. So one of the reasons that it's such a great loan is because the VA is really looking out for you as well. They don't want you to be house poor. They want to make sure that you're making a good decision. And so they really put their guidelines in place to make sure that you're going to be able to afford the monthly payment, you're going to be comfortable, and That's one of the reasons that the VA loan is one of the best performing loans available in the market today. Just to put this into a real world example, let's just say basically that we have someone who has an income of say $8,000, and that's gross again. And in order to stay below that 41% threshold, they would have to have max total payments of no more than $3,280 a month. So that's 41% of the gross income, right? And so from there, what we do is we're going to subtract the existing monthly payments. So if we can't go above $3,280 a month, we're going to subtract the existing monthly payments. And let's just assume that they have a $500 a month car payment and they have $200 a month in student loans and they don't have any credit card debt. They have total monthly debt, total monthly payments of $700 a month. $3,280 minus $700 is $2,580. And that's what's left for the housing payment. See, I said earlier in the video that we're going to back into the housing payment number, right? So we take the income, we take 41% of that, and then we subtract their existing debts. And that essentially is the number that's going to be left over for the housing payment if we want to stay underneath that 41%. Again, we don't have to, but that is a good indication that you're kind of in that really good, comfortable sweet spot for the VA in terms of debt to income ratio. So if we assume that, let's just say interest rates at the time, and interest rates fluctuate all the time. So this is just an example. Let's just say it's 5.5% or a VA 30-year fixed loan. Let's say property taxes are $6,000 a year, which is $500 per month. And let's say that the housing insurance is $1,800 a year, which is $150 per month. Based on this scenario, the borrower could likely qualify for somewhere right around $340,000, maybe just under that. And that, again, would keep the borrower at the 41% debt to income ratio. They could potentially go upwards of $500,000. That's probably going to be, in the mid 50 to income ratio range. It's a big range there. We have from $340,000 to $500,000. Again, this is where the personal decision comes in. You might be able to qualify for $500,000, but are you going to be comfortable? Are you going to put yourself in a situation where you can't afford to live the life that you want to live? Being house poor, right? Not having enough money to live your life. Again, when you take on a mortgage, you have to pay that mortgage every month. So the lender may qualify you for more than where you're going to feel comfortable paying. And that's just something that you have to understand because everybody is different. So by being conscious of your comfort level, you can prevent a lot of pain. You can prevent being house poor. You can prevent financial stress, regretting that you bought the house in the first place. It's very, very important to make sure that you are understanding your comfort level in terms of what your monthly payment is going to be. Some of the common mistakes that I see veterans make when they're trying to calculate these numbers on their own are using online calculators, like online housing website calculators. Those things are notoriously inaccurate. We steer clear of that. Forgetting about things like property taxes and how those may differ regionally from city to city. And then also in terms of how much cash you might need. Even though the VA loan has zero down payment, you still may need closing costs, or there may be prepaid items that you have to bring to closing. Hopefully this video helped you understand a little bit more about how VA affordability is calculated. Hopefully it helped give you a little bit better of an idea of how much you might be able to afford. Now, certainly, you're not going to know exactly how much you're going to qualify for until you talk to a loan officer. They're the ones that are going to run your credit, look at your income documents, review your different types of incomes, and then they're going to be able to give you a much more detailed understanding what your affordability is. Certainly, they should be talking to you about things like your max, so different comfort levels of your monthly payment, so on and so forth. So if that's something that you need help with, feel free to reach out to me. You can call me. You can schedule a link on my calendar in the description below. If you like this video, please click like and subscribe. And I will see you in the next video.